Hello and welcome to Trade Finance Talks. I'm Mahika Ravishankar, Deputy Editor at Trade Finance Global, and we're coming to you today from the inaugural TFG Geneva conference in Switzerland. I'm joined today by Andrew Vandenborn from Willis Towers Watson, and we're going to talk a little bit about the risks and threats to the commodity trading market today. Andrew, thank you for joining me.
Good morning, thank you. Thank you for having me.
So to start off, can you just tell me a little bit about your role within Willis Towers Watson and what brings you to Geneva this year?
So I am Managing Director and Global Head of Structured Credit and Risk at Willis Towers Watson. Been in the market, I guess, over 33 years at a variety of different shops, the last 15 of which at Willis. In terms of what brings me here to Geneva this week, I mean, it's Geneva Commodity Week. It's where the great and the good of the commodity community get together. It's a chance to catch up with old friends and also meet new contacts.
Good, thank you. And to start things off, I came across this report, a Willis Towers Watson report, which talked about the 5 biggest economic risks in commodity trading at the moment. They were tariffs, China's economic risks, the war in Ukraine, the climate crisis, and threats to marine shipping. Which of these 5 risks do you think is the most pertinent?
At the moment, or
At the moment.
Or looking forward? I mean, if I had to probably choose one, I'd probably go for tariffs at the moment, which I think we will continue to see issues arising from tariffs well into 2026. Obviously, single-digit levies can significantly impact margins. I guess the difference there, I mean, tariffs, though, aren't just being used as a means of, obviously, of raising revenue, but they're becoming a sort of a political leverage tool, right? Which creates a huge degree of uncertainty.
Mm-hmm. Thanks. And of those 5 risks, which I guess are the most common based on respondents in the report, beyond those 5 risks, are there any threats to the commodity trading market that you've been observing?
So I think in the report you cited, I think that the 2 other risks, what we sort of view as under the radar type risks, one is EU sustainability regulation, and the other we cited was sort of bond market turbulence or a dislocation in the modern market that sort of tightens liquidity. If I had to choose one of the 2, I'd probably go EU sustainability regulation, because whilst I guess the EU is primarily a demand market as far as commodities are concerned, the application or these regulations will have compliance implications upstream as well, right? So I think we'd probably highlight that as a sort of major sort of under the radar type risk.
Has it been affecting the commodity flows themselves?
It does affect, it creates a degree of uncertainty in terms of complying with the regulations, because whilst these are obviously EU regulations, they are largely probably adopted in other geographies as well, and it creates a degree of an additional compliance risk in ensuring that you've got the right certifications and so forth. With
these risks, things like compliance burdens, what strategies have you found are useful in sort of insulating yourself from any turbulence?
So, I mean, obviously, companies can adopt a number of different strategies. I mean, it is nuanced depending on the geography, right? But I mean, I think all geographies pursue optionality, right? If maybe it's around logistics optionality or supply chain risks, in terms of ensuring that you have either sufficient tonnage available, or you're able to switch the origin of goods to avoid bottlenecks or choking points, right, in the supply routes. So it is about optionality.
Have there been any product innovations with all these new risks? Have people thought about different risk mitigation strategies for a modern era?
So look, I mean, all commodity traders need to have a robust risk management framework, right? And traditional products such as trade credit insurance, political risk insurance still, I think, play a very important part. In terms of new products to the market, maybe two worth mentioning is mark-to-market insurance, trying to sort of soften the P&L volatility with certain assets. And the other, maybe actually not a new product, but trade disruption insurance, so which essentially covers the sort of loss of profits or extra expenses incurred in having to either source a new supplier or reroute supply routes as a consequence of force majeure events or political risks.
I think leads us on to the final question, which is if you had a call to action for the industry to make things a little less unpredictable and volatile, what would that be?
Well, look, I mean, I would say in many respects, the commodity market still, I guess, thrives on volatility, and we saw that during the pandemic, and also in relation to sort of Ukraine-related turbulence. Right, they were able to take advantage of price movements. Volatility rewards, I would say, scale, optionality, book optimization, and everything else like that. That having been said, I think it's a little bit nuanced, and also I think increasingly, traders are going to face policy risks, right, which they're going to have to try and navigate, as we move forward.
Mm-hmm. Thanks a lot, Andrew. Enjoy the rest of TFG Geneva.
Okay, thank you very much.